When you enter a store and buy a pen, it seems simple. But behind that one sale, there are many building blocks: goods, revenue, expense, transaction, and more. To understand the financial language of business, we need to know the basic terms of accounting. Think of them like learning the ABCs before forming sentences. In this video, we'll decode the essential 20 terms used in accounting and why each one matters. Entity refers to the specific business for which accounting is done. For example, Super Bazaar is treated as a separate entity distinct from its owner. A transaction is any business activity involving value exchange, like purchasing goods, paying rent, or receiving money. It may be done in cash or on credit. Assets are economic resources a business owns, like land, equipment, cash, or stock. They help generate future income. Liabilities are obligations the business owes, like loans from banks or unpaid bills to suppliers. Assets is what the business has. Liabilities is what the business owes. Capital is the money or resources invested by the owner into the business. It's shown on the liabilities side as it's owed back to the owner. Sales is the total income from selling goods or services. These can be cash sales or credit sales. Revenue is all income earned through sales, commissions, rent, dividends, and more. Expenses are costs incurred to earn that revenue, like electricity, salaries, and transport. Profit equals to revenue minus expenses. Expenditure means spending money for a benefit like buying furniture or raw materials. If the benefit lasts over a year, it's capital expenditure, example machinery. If it's short-term, it's an expense. Profit is the surplus when income exceeds expenses. This increases the owner's wealth. A gain is an extra profit from an unexpected source, like selling an asset for more than its book value. A loss is when expenses exceed income or when something of value is lost due to theft, fire, or accident. Discount is a reduction in price. Trade discount given at the time of sale to dealers. Cash discount given to encourage prompt payment. A voucher is a document supporting a transaction, like a cash memo, receipt, or invoice. Goods are the items a business deals in. For a shoe store, shoes are goods, for others, they're assets. Drawings are withdrawals of cash or goods by the owner for personal use. This reduces capital. Purchases are all goods bought for resale or production, on cash or credit. Stock is the unsold inventory on hand. Opening stock at the beginning of the period. Closing stock at the end. Debtors are customers who bought goods on credit and still owe money. They appear as assets. Creditors are people or businesses to whom the firm owes money, usually for goods purchased on credit. They're liabilities. Think of a business like a kitchen. Goods are your ingredients. Expenses are the gas, electricity, and wages. Revenue is the food sold. Profit is what's left after all bills are paid. Accounting tracks every item, so you never run out of stock or cook at a loss. Understanding these 20 basic terms is the foundation for learning all future accounting concepts. In our next session, we'll apply these terms to practical examples and see how they come together in real-world financial statements.